Hi guys, this is Sia Jane and welcome back to my channel ACCA and Beyond. And we are continuing with our FR series. And we were talking about chapter number 2, which is about tangible non-current assets. So without wasting any time, I'm going to we left off over here. So let's start from revaluation of non-current assets. So IS for now there's a new IS 16. IS 16 again. I'm just reminding you all, it's not necessary to remember the numbers and the name of the IAS. So IAS 16 allows a choice of accounting treatment for property, plant and equipment. There's two types of accounting treatment which is allowed by the IAS, which is the cost model and the revaluation model. The cost model: property, plant and equipment should be valued at cost less accumulated depreciation. So this model is pretty easy. If it should be just valued at your cost, maybe the cost is 1 lakh and the depreciation is for 10 years. So for 10 years our per year depreciation will be 10,000. So the final cost will be 90,000. So it's simple, it should be carried at this value for the remaining for the next year. This is a cost model, it's very simple. The revaluation model, personally I find it a quite tricky still. So I'll suggest I'll suggest to pay proper attention to this segment of the video. Okay, so the revaluation model. The property, plant and equipment may be carried at a revalued amount less any subsequent accumulated depreciation. If the revaluation alternative is adopted, two conditions must be complied with. Revaluations must subsequently be made with sufficient regularity to ensure that the carrying amount does not differ materially from the fair value at the each reporting date, and when an item of property, plant and equipment is revalued, the entire class of assets to which the item belongs must be revalued. Okay, so what does this say? That the property, plant and equipment can be revalued, and then we can also subtract our depreciation from it. But if we want to adopt the revaluation alternative, two conditions must be complied with. What are these two conditions? That if we are revaluing our assets, they should be done with in regular intervals. Okay, like maybe you revalued your property in December, and December the fair value of the property was 50,000. Maybe in June, July, some the market boosted up or something happened, and the property, maybe a new project came near your building, and it boosted up the market value of a property to maybe 1 lakh, almost double. No, 1 lakh तो नहीं होता इतना, तो जल्दी नहीं बढ़ता. Maybe from 50,000 it became to like maybe 60,000 or 70,000. So you need to reflect that in your financial statements also. So yeah, the revaluation of the assets should be made regularly. And when an item of property, plant and equipment is revalued, the entire class of assets to which the item belong must be revalued. So you can't just revalue one building. Okay, if you have many buildings, and you can't just use the revaluation accounting treatment of revaluation on just one building. You'll need to revalue all of your buildings. So yeah, that's the two conditions which need to be met for the revaluation model. Now, how do we account for a revaluation? We'll first learn the steps. So, we restate the cost to the new valuation. Second, eliminate any existing accumulated depreciation from the asset, and then show the total increase in the other comprehensive income at the foot of the statement of the profit or loss. This would be taken to the revaluation surplus, much like the profit for the year gets taken to retained earnings. So, it's very easy. First, if the revalued property value is 50,000, and if there is any accumulated depreciation, we'll minus it. After that, whatever is our profit, maybe let's say our profit is 40,000, we are going to take it to OCI, and this would be taken to the revaluation surplus. You remember your statement of changes in equity. In your statement of changes in equity, we have an segment called revaluation of surplus. So we take it over there. Don't worry, you are going to practice a few so many sums. There are so many sums in your exam kit also about revaluation. So you will have a very good practice of these steps, and I'll solve an example or sum too. So, recognizing revaluation gains and losses. Revaluation gains are recorded as a component of other comprehensive income, either within the statement of profit or loss and other comprehensive income, or in a separate statement. This gain is then carried in a revaluation surplus within equity. This revaluation surplus is a capital reserve and is therefore not permitted to be distributed to the shareholders. Okay, so it's the same that the revaluation gains are recorded in your OCI, and in your statement of changes in equity it is recorded in your revaluation surplus. But this revaluation is okay. So you tell me, if your fair value of your product is increasing from maybe 50,000 to 60,000, it's a profit for you. But is this a profit in cash? Are you receiving this cash? So no, right? So anyways, you can't distribute this profit as to your shareholders, and it is also not permitted also to distribute these to the shareholders. So revaluation losses now, which represent an impairment of the asset. Impairment is something of your the property value is goes down from 50 to 40. So this is an impairment of your asset, are recognized in the statement of profit or loss. When a revaluation loss arises on a previously revalued asset, it should be deducted first against the previous revaluation gain and can therefore be taken to other comprehensive income in the year. Any excess impairment will then be recorded as an impairment expense in the statement of profit or loss. Note that the offset of gains and losses between different properties is not permitted. Okay, so this is very simple. If previously you have revalued a property from 50 to 60 maybe, you got a revaluation gain of 10, okay, but now the fair value of a property has fallen from maybe 60 to 55, so now you have a loss of 5. So you are just going to minus this from your gain, which you have which is given in your OCI. Okay, from your OCI you're going to minus it, and you will have a 5 profit of 5, and no effect should it's okay if you don't show an effect in the your statement of profit or loss. But if you do not have any previous gains, and your property fair value falls from 50 to 40, you have to show it in your statement of profit and loss. Yeah, and maybe if one more example, if your property was revalued from 50 to 55, you have a gain of 5, but now it has fallen to 45, so you have a loss of 10. So first you will deduct that 5 from your OCI. Your OCI balance should be 0, and then in your PNL you will show the 5 rupees loss. So this 10 rupees loss is divided into 2. First is in your OCI and second is in your PNL. So you first offset it against the property, against your OCI, and the remaining amount is shown in your PNL. And this notice that you can only do this with same building. Okay, if you have a building in Malhad and that building is revalued first, and after that it was impaired, so you can only offset it against that building. You cannot offset it against a building you have in Surat or something. It can be only done in that building. Okay. I'm not going to do an example. I'll solve a sum which is given below. Okay. So now let's look at depreciation of revalued assets. Once an asset has been revalued, the following treatment is required. Depreciation must be charged based on valuation less residual value. So I have explained this earlier. Residual value is the scrap value which you'll receive when after your asset is no longer in use. So you sell that asset, and any remaining amount you get is your residual value over the remaining useful life of the asset. The whole charge must go to the statement of profit or loss for the year. An annual reserve transfer may be made from revaluation surplus to retained earnings for the additional depreciation charge on the revalued amount compared to cost. This permitted treatment under IAS 16 is to address the imbalance between a non-distinguishable gain held in revaluation surplus and the reduction in retained earnings due to the increased depreciation charge. This transfer would be shown on the SOCIE, which is a statement of changes in equity. So it's just that if you have any revaluation surplus, and one second now. Yeah, so if you have any reserve revaluation surplus or any depreciation charge, you can transfer it from your IAS 16. According to IAS 16, you can transfer it to your revaluation surplus, which is given in the SOCIE. And these are the journal entries. I don't think journal entries are that much in use, but yeah, it's of course important to understand the concept. The transfer. Okay, so let's look at test your understanding too. I hope it will clear up some concepts for you guys, and if it doesn't, feel free to drop some comments, drop your doubts in the comment sections. Okay. So on 1st April 2018, the fair value of ex-use property was 1 lakh with a remaining life of 20 years. So what does that make our depreciation? Our depreciation will be 1 lakh divided by 20. I guess it will be 5,000. I'm sure. I'm not wrong. Okay. So Axios policy is to revalue its property at each year end. At 31st March 2019, the property was revalued at 86,000. Now you tell me, 1st March to 31st 1st April to 31st March is 1 year. So we'll charge 1 year's depreciation. So 1 lakh minus 5,000, a property value will be 95,000. And the property was valued at 86,000. So we have a revaluation loss, and the loss is of 95,000 minus 86,000 is 9,000. The balance on the revaluation surplus at 1st April 2018 was 20,000, which relates entirely to the property. So it's we have a revaluation surplus which is for this property only, which is of 20,000. Now think, we have just discussed this. We can set off this loss against this profit in our OCI, which relates entirely to the property. Actually does not make a transfer to realized profit in respect of excess depreciation. Now what are we required to do? First, prepare extract of excuse financial statements for the year ending 31st March 2019 reflecting the above information. And second, state how the accounting would be different if the opening revaluation surplus did not exist. So first, we'll charge a depreciation for this year also, for 31st March 2019. 1 second, okay. Okay, so we have to make 3 different statements. We have a statement of profit or loss, statement of financial position, and statement of changes in equity. So where should I solve this? I'll solve it over here. It's going, but it will automatically erase within like 15 seconds, but I have no other space to do my work. Okay, so we have a statement of profit and loss. So in a statement of profit and loss, first we have your OCI. In your OCI, we already have a revaluation profit, so we are just going to set it off a revaluation loss, which is of 9,000, and we are going to charge this year's depreciation also, which will be of 5,000. Now we have a statement of financial position. In that, our new non-current asset value will be property would be at 6,000, because we have already set off the loss in our OCI. And within our equity section, first we had a revaluation surplus of 20,000, but now it has fallen down by 9,000, so our new revaluation surplus will be of 11,000. And the last part which we have is our statement of changes in equity. It's very easy. First, our opening balance was of 20,000, revaluation surplus, opening balance 20,000. Now we just have a loss to account for, which is of 9,000, and our closing balance would be of 11,000, and that's it. You just have to account this 9,000 in all 3 of your statements, and that's it, done. So I guess you can solve test your understanding 3 like that, and if you have any doubts, please feel free to comment down. 1 second. One thing I forgot to discuss, if there would have been no revaluation surplus to start with, what would have been done with our loss? It's very easy. Everything else is going to remain the same. In your SOCI, you would have no opening balance, so it would just be loss of 9,000. In your statement of profit and loss, you would have no OCI, okay? It would just be an impairment loss in your loss section, in your debit section of 9,000. That's it. No else change. Okay. Now, disposal of revalued non-current asset. The profit or loss on disposal of a revalued non-current asset should be calculated as the difference between the net sale proceeds and the carrying amount. So, whatever we receive versus what is the carrying amount in our books is what is the profit or loss on the disposal of a non-current asset. That's simple. There are two steps to disposing of a revalued asset. It should be accounted for in the statement of profit or loss of the period in which the disposal occurs. Any balance on the revaluation surplus relating to this asset should then be transferred to the retained earnings. So yeah, it would of course we'll have to account it for in the statement of profit and loss, and whatever revaluation surplus we had in a SOCI, we'll then transfer it to retained earnings. This does not affect our other comprehensive income, which is only altered when the asset is actually revalued upwards or downward. So we don't have to make any major changes in our OCI. Now we are going to learn a new IAS, which is IAS 20 for government grants and disclosure of government assistance. I find this IAS quite simple. So yeah, one second. Okay, so introduction. Government grants often provide money or incentive to companies to export their goods or to promote local employment. Government grants could be revenue grants, example contribution towards payroll cost, or capital grants, example contribution towards purchases of non-current and non-current assets. One second. So revenue grants are grants which are given towards day-to-day expenses which a company has, and capital grants are grants given towards it's like a major investment for something that is long term. Okay, so now the general principles. IS 20 follows two general principles when determining the treatment of grants. Prudence. Grants should not be recognized until the conditions for receipts have been complied with and there is reasonable assurance that the grant will be received. So unless you're like completely, or maybe like you need to be like so sure that the grant will be received, you cannot realize this in your statements. And accruals. Grants should be matched with the expenditure towards which they were intended to contribute. So yeah, if you're receiving a grant for an investment in a property, plant, or equipment, you need to offset it against that only. You cannot use it to offset it against anything else. Now the definitions. Government agencies, and similar bodies, whether local, national, or international. So it can be any small or big organization from which you receive a grant. It's okay. Government assistance is action by government designed to provide an economic benefit specific to an entity or range of entities qualifying under certain criteria. Example: the grant for a local operating license. So you can of course receive government assistance also, um, which is different from a grant because you're not actually receiving money but you're receiving help from the government. Government grants are assistance by government in the form of transfer of resources to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. Government grants are, you will receive monetary items like money, or maybe you will receive some um, uh, property or some equipments in return, but you will have to comply with the rules which governments imply on you. And government relate grants related to assets are government grants whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire long-term assets. So this is pretty self-explanatory that the grants related to assets are assets uh, given by government have the primary conditions that an entity qualifying for them should purchase, construct, or otherwise acquire long-term assets. Grants related to income are government grants, and other than those related to assets known as revenue grants. Okay. Revenue grants. The recognition of the grant will depend upon the circumstance. If the grant is paid when evidence is produced that certain expenditure has been incurred, the grant should be matched with that expenditure. If the grant is paid on a different basis, example, achievement of a non financial object, such as creation of a specified number of new jobs, the grant should be matched with the identifiable cost of achieving that objective. So, if maybe your grant first case scenario, your grant is maybe of to purchase a property, and if you purchase that property, if that property's value is 1 lakh, and if you purchase that property, you will receive a grant of maybe 50,000. So you can just offset it against that, and you can show in a books that you have the cost of that purchasing of that property is 50,000. But if you, sometimes government to increase employment opportunities, they have grants if you create like maybe 10 more jobs or 20 more jobs, you will receive 20,000 grant. So what you can do on that basis, if you have you'll obviously have payroll cost because you are employing new members. So you can so let's say our payroll cost is of 50,000, and you are receiving a grant of 20,000 for doing that, so you can offset it against that cost. Now, presentation of revenue grants. IS 20 allows such grants to either be presented as a credit in the statement of profit or loss or deducted from the related expense. So, you can obviously deduct it from the related expense also, or if you can show you have payroll cost of 20,000, 50,000, and in your credit side, you can show grant received also of 20,000. So you can either do these two separate adjustments, or you can do one entry also. It is totally up to you. Okay. Presentation, revenue grant presentation as credit in the statement of profit or loss. Supporters of this method claim that it is inappropriate to net income and expense items, and that separation of the grant from that expense facilities comparison with other expenses not affected by a grant, and deduction from a related expense. It is argued that with this method, the expense might well not have been incurred by the entity if the grant had not been available, and presentation of the expense without offsetting the grant may therefore be misleading. इसमें क्या है मतलब अभी the government was giving me grant now of 20,000, that's why I'm incurring 50,000. I thought okay ठीक है, my net cost is just 30,000, so that much I can do. But if the government was not giving me any grant, I would have not considered employing more employees from my firm, because I was happy with whatever employees I had. So because the government is giving me grant, I'm employing more employees. So yeah, that's why there is a little bit of debate of whether the grant should be offsetted against the expense or not. An entity, okay, let's look at an illustration. An entity is given 3 lakhs on 1st January 2011 to keep staff employed within a deprived area. The entity must not make redundancies. Redundancy is firing of people for the next 3 years. So that's a condition, that you cannot fire anyone for the next 3 years, or the grant will not be repaid. By 31st December 2011, no redundancies have taken place, and none are planned. The grant should be released over 3 years, meaning that 1 lakh. Okay, so that was a question. So what is the accounting treatment? 1 second. Okay, so what you will do is, you have 3 lakhs for 3 years, right? So you cannot you cannot realize all of these 3 lakhs are together in your statement of profit and loss, because you have 3 years to do that. So you are going to do it 1 lakh 1 lakh per year. So you can do two things. You can just set it off against your payroll cost, or you can show it as a separate item in your credit side of a profit or loss. And for that 2 lakh which is remaining, we'll create a liability, because it is a liability. Okay, we don't know, maybe in the next 2 years we might fire off some people. So for now it's a liability. But the 1 lakh of, we have 2 lakhs in that, right? Let's use 200. So we have 2 lakhs in that, right? So that 1 lakh out of which 1 lakh would be used next year, so that is a current liability, and the remaining 1 lakh we'll use it after 2 years, so that is a non-current liability. That's it. That's how we present it in the financial statements. Let me just see how long this chapter is. Maybe I need to make 2 videos. Yes guys, I don't think I have today I have the time to complete all of this. Otherwise I'll just have to rush it. Instead of this, I'll make another video for the remaining part of the chapter. If you have any doubts, please feel free to comment down. If you have any suggestions also, please feel free to tell me. And yeah, that's it for today. If you like this video, please like, share, subscribe and share it with your friends. And thank you so much for watching.